Welcome to this video. My name is Frank. Most people call me Frank Millionaire, and I want to waste a bit of time. We have to get to the point today. So basically, this video is made for the purpose of making everyone get to know where the market started. Okay, where did we start from? So is what we're going to be looking at. How did the forex market start? So I'm gonna briefly tell you a story. Now this is it. Initially, we started trading with barter trading, and it started in ends of Mesopotamia. Yeah, Mesopotamia. That's where barter trade started from, and there was a market there. Of course, ships used to go there and ABC. Then later on, fast forward. Things like the East Indian voyage came in place, and this came in place because investors were losing money. So a company was created where investors would put their money, and then it would go on to make them a huge number of money. So the East Indies voyage was the first company in the world to have shares sold. Okay, that's around in the 1600s there. And well, fast forward again, the stock market started, and of course initially they were on phone calls and contracts. Okay, they were contracts. So if you've seen videos like this whereby it's a whole heck of people in the Wall Street shouting prices and stuff like that. That's how chaotic it was. Then later on, the electronic trading came in place, and yeah, instead of contracts, we are now using indicators. Indicators like this that you're seeing, the bar chart. Now, I've seen people saying, "Oh, indicators, I hate indicators," stuff like that. But then, just so you know, you've been lied to your whole life if you're told that this is not an indicator. What you're looking at right here. I'm using TradingView. It's a free thing, an app, and you can use it, but then you can also pay for it. So this is an indicator. Okay, so you can read these charts using a numerous number of indicators, from bar charts that look like this. I think I'll zoom in a little so that you can see this. Okay, from bar charts that look like this to what we call the candlesticks. These are commonly used, and we shall see why. Then to what we call the hollow candles. Then we have the columns. You can read the column. It's a bit confusing for people, but there's also the line chart. So basically, when it comes to electronic trading, we are basically all using indicators. Like it or not, we are using indicators, and I'm very sure you guys, if you've been on Google and then you try to search the price of something, you're shown an indicator of a line or of an area, a line graph like this. So basically, we all look at price using indicators. So there are basically a lot of these indicators, a lot of them, but we shall stick to the candles that most people are used at seeing. Okay, so basically, these candlesticks, what do they mean? If it's your first time trading, the red candles say price was going down, the green candles say price was going up. Now I know this can be a little bit confusing, especially that you see price was going down, price was going up. You understand, it's more like a mix, but we shall get into the depth of that later on in the future videos. So first things first, today we are here to talk. I've just described to you what how forex started. So basically, I'll just make this color green just to show that we're done with that. All right, so we're going to our number 2. This, how is the data represented in the candlesticks collected? Now I want you guys to see this. So how is this data collected? How do these candles come to represent that price is going up and it's going down? Now I'll use an example, because if you do not understand these markets this way, you're going to have a very hard time understanding the whole forex exchange market. Now this is it. Take this as a supermarket. All right, I'll just write this. This is a okay, just a minute. This is a supermarket. Okay, this is a supermarket. All right, I need to take this as a supermarket. I think I might have a problem with this. Just a minute. Okay, sorry for that. I just want to make this very easy for everyone. So let's do this. Let's take this as our supermarket. Okay, because this is a great example of transactions. Okay, so this is our supermarket. All right, now inside the supermarket, how the supermarkets collect their data is, this is how they collect their data. I'm gonna get this one here, and I want you guys to see this. I'll change the color of this to, I think, red. Yeah. So supermarkets collect their data by looking at the transactions or the orders, okay, that have come in, and then also looking at the prices. So yes, people came and made orders, but then after people came in and made orders. Just a minute, I want to change this. Let me see. Okay, good. I'm going to change this background to, I think, this. All right. And I think I'm having problems with the text color. I'm just doing this. Be patient with me, please. I think this is not wise, is it? All right. So, other side. As I earlier said, that when people come, okay, when people came to the supermarket, they made orders, all right, but then they made those orders based on a certain price. Okay, I want you to get this. All right, they made orders based on a certain price. These transactions that came in here. All right, I'll call them orders just for everyone's understanding. Stroke transactions. Okay, stroke transactions. I'll just make this a little bit bigger. All right, so transactions came in, or orders came in at a certain price, as we've just discussed. Okay, so this means that when you come to this chart that we are looking at, our chart, we have what we call price. Okay, these numbers that you see counting this side. Okay, these numbers that you see counting this side, this is what we call the price of the product that we are looking at. And then down here we have what we call the time that these orders came in. I'll change this to blue as well. Okay, so down here where this blue arrow is pointing, we have what we call time. So you can see that right now this is pointing at 30th of August 2022, but then this one is pointing at these prices. Okay, 1,744 point that. Those are the prices that it's pointing at. So basically, when we're looking at the markets, we're looking at price, and we're also looking at time. Basically, this is the retail way of looking at price. Okay, this is the retail way, and the intention of these videos are to I'll do. Alright, so as I was saying, the intention of these videos is to help people not to, stick on the retail way of analyzing. Okay, so basically I have a lot of things on my chart right now, and I'm going to delete some things here. I had a few glitches in the system, so basically the intention is to stop people from analyzing like hotels, and then they start analyzing like institutions. Okay, so institutional analyzing, non-retail. All right, so as I was saying, now basically as institutional traders, as I say, that supermarkets are always looking at two things. They are looking at, number one, they are looking at the amount of orders that is coming in, and they're also looking at which price are people really taking the product, a particular product. Okay, so this is it. They base on what we call data, okay, not predictions. I'll type this so that you guys can get this. Okay, base on data, okay, not do this, not predictions. Okay, I'll do this so that you guys can see this. Okay, based on data, non-predictions. I'll change this to a color like black. Okay, so based on data and non-predictions. So what do I mean? If somebody is operating like seeing the markets just like a supermarket, okay, they will notice that this is a product that they are looking at. This is a certain product, as we've said before, that initially I'll delete this. Just a minute. So as I've said, that when you're looking at the price chart, you're basically looking at price here, and then looking at the timestamp down here. Okay, so the red arrow is pointing at the timestamp, and then this is pointing at the price. So this is price, and this down here is the time. Okay, you can see the date is 26th. You can see this 26th of August, and here this is the price currently. All right, so while that is there, I want to say nothing different. Okay, so while that is there, we have to make sure that we look at data, not predictions. So how do you analyze based on data? How do we analyze as institutional traders? We have tools that because the only way, as I've shown you while we're starting the video, is that these are orders or transactions that are happening. So let's say that this we're going to call this, let's say that this is a chart for sugar. Just a moment. Sugar. So this is a chart showing sugar. Okay, in my language this is called sukari. So let's say that we are looking at the price of sugar. Okay, I'll make this a little bit smaller. Okay, and I'll decrease its size because I hope everybody has already seen it. Even if I leave it here, I don't think it has an effect here. So let's say this is the price of sugar. I'll do this. Just a minute. Just a minute. Just give it that color green. Okay, give it that color, and then maybe the text itself, give it that color. Alright, so anyway, let's say we are looking at the sugar. The chart that we are looking at is the chart for sugar. Now it doesn't make sense for you to only be seeing the price, right? But then you're not seeing the orders, does it? Because then on this chart you're only seeing price, and time. That's what you're seeing. You're not seeing the transactions, okay? And this doesn't make sense. So basically you're doing what we call gambling, okay? Basically you're gambling. This is price, and then this here is time, okay? But you're not seeing the orders. So how do you see the orders? This is why I told you that we need to be based on data. This is why we look at instruments, just like the footprints, okay? So this is my footprints right here, and you can see I can see the amount of orders in every little bit of it. We used the footprints will show you the amount of orders, and then you'll also be able to see the points of control, right? So this helps you while you're trading, okay? And of course I'm not here to exhibit this, all right? And I just go back to where we were. So this is the price of sugar. So can you say, does it make sense for you to say that the price of sugar is going up, okay, without demand, without transactions asking for sugar? Because this is the basic commerce, and I'm going to show you this and to explain it in the easiest way possible. The law of demand states that the lower the price, okay, because this is the price point, you guys remember this is the price point, okay? The lower the price, the higher the demand, okay? And the higher the price, okay? The higher the price, the lower the demand, okay? This is just basic, it's just basic commerce, okay? So we cannot say that price is going up because it's going up. There have to be orders. So this is the same reason, by the way, why supermarkets dictate their prices. So it's simple commerce or simple transaction knowledge that when the supermarket sees a certain product, let's say sugar for this case, okay, having a higher demand, they are going to increase the price, okay? So the price will go up, right? And if it realizes that demand for sugar is not high, they're going to reduce the prices so that the demand can go up, okay? But once the price is up, people will stop buying. Of course, this happens when the price of something goes up. People only buy it if only they really need it, okay? Other than that, they can live without it. So that's why the price has to go down. It has to decrease, okay, to enable more orders to come in. All right. So this is the institutional way of looking at things. You look at every player as a product, okay? So in this case, when you're looking at orders and also looking at the price, you're basing on data and you're not predicting. Otherwise, somebody is going to just say the technical analysis, because now we're at a point where we're saying why you keep losing in the financial markets and why technical analysis is rubbish. Basically, the reason is because these people do not know why price stopped here or why it stopped here while it was going up. They don't know, okay? Because they can't see the orders. So basically, they will come up with some theories here and then basically mess up everything. So the word auction market theory means, okay, because when price goes up, okay, the auctions, the orders inside the market decrease, okay, and when it goes down, the amount of orders increase. So it's an auction market. Basically, people are auctioning, okay? So this product or the sugar is being auctioned. So for this case, we are looking at a pair which is gold spot, okay? Gold spot, just a moment. Gold spot versus the US dollar, okay? or some of you know it as AU USD. This is how you know most of you this pair. So in this case, this will be our sugar or our product, the pair that we're trading. Okay, so the higher the price, the lower the demand. Okay, the lower the price, the higher the demand. Is basically what we want to look at. But then you also need to be able to look at the orders or transactions that are coming in the market. That is where we go to our footprints. Okay, that's where we go to our footprints. So basically, these videos will be enlightening more on how to, even if you don't have systems like this, on how to become profitable in the shortest time possible. And those you can really comment on your comment about the video. If you have any questions, it will also make it easy for me to really help you answer your questions in the next video. It will be nice to look at it that way. Other than that, farewell. Thanks for watching.